Sudeep, are you happy or you sad?
I'm indifferent, Evan. I've got the minutes right here.
Okay.
And
well, what are they saying? The markets, just quickly, the markets turned up on the news, and I'm not expecting any news. Is there any news, Sudeep?
There's actually very little news. We knew that the Fed was a little uncertain about the economic outlook going into that meeting in late April, and they indicated that. There's some evidence that some members of the FOMC saw the economy firming. Some saw some greater concern about the situation in Europe. Several members, these minutes say, indicated that additional policy accommodation, meaning more easing, could be necessary if the economic recovery lost momentum or downside risks became large enough. So it's clearly the minutes, they read like a Fed that's not eager to do more easing, but is certainly prepared and willing to do more if it were to come to that. But there are really no signs in it. And of course, these are old views, given how much the situation has changed in the last couple of weeks.
Sudeep, let me just bring in Spencer Jakab, who had a very interesting ahead of the tape. A lot has happened over the past few weeks since the Fed got together. And again, these are the minutes from that meeting. Greece is one. Second is price of gas has continued to fall, which is probably the single biggest inflationary pressure that the Fed is most concerned about. And third, the stock market's gone down. What do you think is going on right now in the Fed? Let's put aside the Fed minute, Spencer.
Well, so I mean, it's a paradox because this is one of the most closely watched pieces of information coming out of the Fed, but it's so old. It's not that old, April 24th, 25th, but a lot has happened, as Sudeep said and you said. So prices of the gasoline prices have come down, and that's bringing CPI down. We had a pretty good read. We're down to 2.3. We were at 2.7 before that, 2.9 before that. We were 3.9 in September. We don't have the so-called core PCE deflator, which is what the Fed likes to see at 2% or below in order to act. That was last reported in March at 2.4%. But that's heading in the right direction, too. So it's really what's happened since I think that people are using the handicap.
Sudeep, QE3. Look, I don't even want to talk about this really much longer, but what are the odds that we're going to get any hint about QE3 out of the Fed sometime in the next week or two? Because that's all the market really cares about right now, isn't it?
There's no chance we're going to get any meaningful signal of QE3 out of the Fed in the next week or two, unless you were to see a disastrous meltdown in markets, and then we might only get a hint of this. But Spencer's point is really important, that we're seeing some of the forces converge here. We're coming together to the notion that you've got inflation easing back a bit, you've got growth slowing, markets are pulling back, and you have to look at what the calendar looks like for the Fed. And the next Fed meeting is coming up just 2 days after the Greek election. So we don't know yet whether all of Europe and the global market, all of global markets will be in a meltdown by the time the Fed next meets. But if all of these forces are converging and you actually do have some kind of disastrous scenario, then the Fed's not going to resist doing something like QE3 if it's got this meltdown going on around it. But barring that, they're going to be extremely cautious about moving forward very quickly.
Spencer, quick question. Okay. What are the odds here that the Fed is going to do something anytime soon? And what will it take? What will it take until the stock market gets off this addiction to the Fed? I need a quick answer. Solve all our economic woes in about 15 seconds.
If you're having a Lehman moment, the Fed is certainly then all, the whole playbook changes, right? So that, as Sudeep said, but what the Fed can do is talk the talk and not walk the walk, in the sense that they can they don't have to wait until the June meeting. Between now and then, or at the June meeting, or any point in between, they can hint that they're going to turn more dovish, and that, if you look at past examples of QE, that was enough to boost asset prices, and that's really what they affect when they do QE, is asset prices, not so much yield.
Final question, Sudeep. I hope you're still there. Sudeep, what are the odds that we're going to break this addiction to the Fed minutes, to every speech that is made by Ben Bernanke? When are we going to get off the junk?
Every speech is going to, markets are going to be looking for any hint that Ben Bernanke might have moved an inch closer to QE3, when in reality he's really going to just leave the door open for a very long time, to make it very clear that the Fed has this tool, can pull out the bazooka, but probably will not anytime soon unless you have a global meltdown around us.